The issuance of U.S. Treasuries has nearly doubled since the start of the pandemic, reaching a record $23 trillion in 2023, with expectations of continued growth regardless of election outcomes. Concerns arise due to historical market instability with rapid growth, particularly in the safest securities like Treasuries, which could potentially spread instability. Additionally, new trading rules may alleviate strains, but also introduce unforeseen consequences. Despite the mounting debt, demand for Treasuries remains strong, partly due to limited alternatives in the market. Banks have reduced their Treasury purchases, while hedge funds, money market funds, and foreign investors have become primary buyers. Hedge funds, classified with households in Fed data, have largely filled the void left by the central bank reducing its bond holdings. However, a popular trade involving Treasuries and Treasury futures faces regulatory challenges, potentially reducing profitability and prompting lawsuits. Foreign investors, although steadily buying Treasuries, might slow purchases due to a strong dollar and increased availability of high-quality bonds elsewhere. Despite dollar strength, Japanese investors have increased their Treasury holdings, surpassing China as the largest foreign creditor. Tighter regulations aim to prevent market disruptions related to government debt, such as those seen during Lehman Brothers' collapse and the March 2020 panic. The Fed and SEC are implementing safeguards, including routing more trades through central clearinghouses to offset regulatory burdens and enhance cybersecurity. Despite potential higher trading costs, regulators aim to improve market conditions and resilience in the face of shocks. The International Swaps and Derivatives Association has proposed reviving a pandemic-era policy to address concerns in the Treasury market. This policy would allow banks to exclude Treasuries and central bank deposits from regulatory buffers, potentially enabling them to finance more U.S. debt and bolster their balance sheets during market strains. However, some fear that without addressing the mounting debt, bond yields could remain permanently higher. Factors such as inflation risks from wars, expansive fiscal policies, deglobalization, and immigration suggest that interest rates may stay elevated compared to pre-pandemic levels. Long-term bond investors are advised to consider the duration of elevated interest rates as a crucial factor. For more articles like this, visit agnescore.com.